of AI revolution and deliver unprecedented value to our customers across the industries that we service, and also have a leapfrogging of our capabilities and service offerings powered by AI across our service stack. We'll continue to highlight the progress on this topic in the subsequent quarters. Now coming to the management updates. In line with our growth aspirations, we continue to add muscle and fortify our management team. We welcomed Dhanashri Bhatt as our Chief Operating Officer. With our over 28 years of experience, Dhanashri will further strengthen Persistent's operations to ensure client success. She'll be responsible for talent supply chain, delivery excellence, learning and development, enterprise risk management, IT, and facilities, among others. Prior to joining Persistent, Dhanashri was the Chief Delivery Officer of Communication, Media and Telecom vertical at TechMahindra. We also welcomed Bharat Narayanan as our head for global BFSI business as well as our Europe geography. Bharat comes with over 24 years of experience and brings to us deep experience in managing large P&L units, shaping and winning large deals, managing consulting businesses, and delivering complex programs that drive growth and profitability. Prior to joining Persistent, Bharat was heading the digital and cloud business globally for Wipro. Coming to the ESG and administrative updates. As we continue our journey on our commitment to be among the best in class for our ESG endeavors, I'm glad to report that our corporate sustainability assessment S&P Global score has moved from 47 to 60. On the scope 1 through scope 2 emissions, our aspiration is to become carbon neutral by 2025, and towards this, we are working on sourcing 100% of our electricity consumption from renewable sources. Our efforts are now towards net zero carbon emissions, much ahead of the stipulated timeline 2050 set by United Nations Intergovernmental Panel on Climate Change. On the facilities side, we inaugurated a new office in Kochi, Kerala in November 2023 as part of our continued efforts to reach out to locations where our employees are based. We also expanded our presence in our New Jersey office in the US. In summary, we are pleased with our performance in Q3 FY24 in a challenging business environment. I would now like to invite Sunil, our CFO, to give a detailed color on the quarterly financials and related matters. Sunil, over to you.
Thank you, Sandeep, and good morning, good day to all. Thank you for taking time to join us today. Wish you all a very happy 2024. Sandeep has shared some business outlook. Let me now walk you through the financial performance for the quarter ended 31st December 23. The revenue for the quarter was $300.55 million, the growth of 3% quarter on quarter and 13.7% YOY. Revenue for the quarter in rupee terms was rupees 24,982 million, reflecting growth of 3.6% quarter on quarter and 15.2% YOY. For the 9 months, the cumulative revenue is $875.2 million with a growth of 14.9%. In rupee terms, the revenue for 9 months is 72311 million, reflecting growth of 18.6%. Coming to sequential growth for the quarter at segment level, healthcare and life sciences grew by 16.6% quarter on quarter. High-tech and emerging verticals grew by 0.1% quarter on quarter, while BFSI declined by 0.7%, mainly on account of furloughs. As you know, seasonally Q3 of the year is impacted by furloughs. The overall impact on the margin was 60 basis points during the quarter due to the furloughs. There is an increase in on-site effort mix, which you will observe, which is due to initial phase of deal ramp-up of the deals won in the previous quarter, which is also reflected in increase in subcon expenses. The impact on margins due to the higher on-site mix was about 60 basis points. So these margin headwinds were more than compensated by margin accretive composition of IP revenue, which contributed 80 basis points, higher utilization, and lower travel expenses, each contributing 30 basis points, and SGA rationalization in Q3, coupled with benefit from headcount optimization undertaken in Q2, contributing the majority of remaining improvement in margin of 60 basis points. Attrition continued to decline in line with industry trend, with TTM attrition at 11.9% as compared to 13.5% in the previous. With this, the EBITDA margin for the quarter was 17.7% as against 16.8% in the previous quarter. EBITDA for 9 months period stands at 17.6% vis-a-vis 18.1% for the comparable period last year. Depreciation and amortization was 3.1%, same as in the previous quarter. The increase in amortization in absolute terms is due to amortization of software used for internal systems. We have been working on strengthening these to support the increased scale of operations. The EBIT came in at 14.5% as against 13.7% in the previous quarter, and EBIT for 9 months period stands at 14.4% vis-a-vis 14.8% for the comparable period last year. As I had mentioned in the earlier quarter, we have invested in sales and marketing, and there is an increase in G&A expenses due to more employees working from office. The treasury income for the quarter was rupees 181.08 million as against 166.28 million rupees, mainly on account of improved cash flow. Forex gain was rupees 80.9 million as compared to 83.7 million in the previous quarter. Profit before tax for the quarter was rupees 3893 million at 15.6% as against 14.8% in the previous quarter. ETR was 26.5% as compared to 26% in the previous quarter. PAT for the quarter was rupees 2861.3 million rupees at 11.5%. YTD PAT for 9 months was rupees 7782 million at 10.8%. Excluding the one-time expense in Q1 on $1 billion milestone celebration, PAT was 11.3%. EPS for the quarter was rupees 37.83 as against 35 rupees in the previous quarter. ROC for the quarter was 29.3% as against 30.2% in the previous quarter. ROC is based on trailing 12 months EBIT. The operational capex for the quarter was rupees 321.32 million. Cash conversion for the quarter continued to be good at 101% of EBITDA. And OCF to EBITDA for 9-month period ending 31st December stands at 0.71 vis-a-vis 0.60 in the corresponding period last year. Total cash and investment on books is rupees 18472 million at the end of December as compared to 15693 million rupees at the end of September. The DSO came in at 66 days, same as in the previous quarter. Forward contracts outstanding at the end of December was $240 million at an average rate of rupees 84.04 per dollar. Couple of other updates for this quarter. As you know, Q3 is usually the quarter in which we declare interim dividend, and I am pleased to share with you that the Board of Directors declared an interim dividend of rupees 32 per share for FY24 on the face value of rupees 10 per share. This compares to the last year's interim dividend of rupees 28 per share. It's our endeavor to maintain consistent dividend payout ratio while we augment our growth through capability-led acquisitions. In order to make it more convenient for shareholders to participate in Persistent stock, the Board of Directors has also recommended to the shareholders a resolution to split the face value of shares from rupees 10 per share to rupees 5 per share. This will be subject to shareholders' approval, which will be processed in due course. Thank you all, and now I hand it to Saurabh for covering deal wins and awards and recognitions. Saurabh.
Thank you, Sunil. I will now talk about key deal wins for Q3 by industry segments. Let me begin with software, high-tech, and emerging industries, our largest vertical. Persistent was selected by one of the leading providers of remote work tools for collaboration and IT management to transform its Salesforce-based applications, connector factory, and IT service management under a managed services model. This is a $50 million plus TCV deal, and is another major successful win for our private equity channel. Persistent was selected by a leading publisher to establish a greenfield ID setup and provide managed services over a 5-year period. This entity is a newly formed organization as part of a carve-out done by a leading private equity from a global media conglomerate. This is another case study of Persistent's established framework for carve-out transactions which leverages Persistent's intelligent IT operations framework and components from hyperscalers and leading technology vendors. Persistent was selected by two of the hyperscalers as a strategic partner for the development and support of their connector development programs. These deal wins are special because they provide us access and partnership with the next generation tool development programs of these hyperscalers, including in the generative AI domain. Coming to banking, financial services, and insurance. Persistent was selected by one of the largest US banks to develop and maintain its applications across domains such as capital markets, payments, treasury, and customer support. This is a $50 million plus renewal deal where Persistent is also a beneficiary of vendor consolidation. Persistent was selected by a leading Canada-based provider of financial technology to credit unions for developing and supporting the core banking platform, which will be rolled out to more than 40 credit unions. As part of the engagement, Persistent would also manage the cloud and security operations of the customer. Persistent was selected by a large global financial conglomerate to modernize its security operations center for its American operations, including providing a holistic view of its security posture to the top management. This is a managed services engagement with complete ownership with Persistent and has the potential to be replicated in other geographies for the customer. And finally, within our healthcare and life sciences vertical, Persistent was selected as a strategic partner by a leading analytical instrument company to engineer their key product suite, including building data analytics capabilities for the chromatography platform, instrument support solutions, and algorithms for microarray images. This is a large renewal deal with one of the largest healthcare customers for us. Persistent was selected by a Fortune 500 scientific instrumentation company to undertake upgrade and migration of the database for its clinical research group while ensuring regulatory compliance in the US and Japan. Persistent was selected by a leading pharma contract research, development, and manufacturing organization for development of artificial intelligence-led drug discovery platform. This platform will accelerate drug discovery process from molecular design to preclinical candidate selection by creating a central, reusable repository for quick decision-making for compound synthesis and biological evaluation. Now, moving on to the awards and recognitions for the quarter from leading analyst firms. Q3 saw us get continued recognition from industry-leading analyst firms and associations. To mention a few, Persistent was recognized as the only provider to win in 4 different categories in the Star of Excellence Awards based on voice of the customer. The ISG Star of Excellence Awards, part of the ISG Provider Lens Research Program, is the premier industry recognition program for the technology and business services industry. These awards recognize exceptional client service experience and serve as a benchmark for measuring client centricity in our industry. Following were the categories in which Persistent was recognized. Persistent was recognized as ISG Star of Excellence, Universal Industry. Persistent was recognized as ISG Star of Excellence, BFSI Industry. Persistent was recognized as ISG Star of Excellence, Healthcare and Pharmaceuticals Industry. And finally, Persistent was recognized as ISG Star of Excellence, Cloud Native. Additionally, Persistent was recognized as a Breakthrough 15 provider in the Q3 2023 ISG Global Index for the second consecutive quarter. Persistent, moving on from the ISG Awards, Persistent was recognized as a leader in IDC MarketScape's Worldwide Software Engineering Services 2023 Vendor Assessment. Persistent was recognized as a leader in the Zinnov Zone's ER&D Services and Digital Engineering Services 2023 report for the 11th year in succession. Persistent was recognized as a Best Enterprise Services Vendor of 2023 by Constellation Research. This completes the section on key wins and awards and recognitions. With this, I would like to conclude the prepared comments and would like to request the operator to open the floor for questions.
Thank you, sir. We will now open the call for Q&A session. We will wait for a few minutes until the question queue assembles. We request participants to restrict to 2 questions and then return to the queue for more questions. Please raise your hand from the participant tab on the screen to ask questions. Okay. The first question is from Sandeep Shah.
Yeah. Good morning. Can you hear me?
Yes, we can.
Yeah. Congrats on a good execution. Sandeep, just wanted to understand, entering into 2024, any signs of recovery in a discretionary small size, faster converting deal wins in terms of client discussion, starting some of the projects which are put on hold in any of the verticals?
Look, from our perspective, yeah, the discretionary spend, we are seeing some green shoots, but I wouldn't say that the environment is any significantly different from the last few quarters. Most of our growth, if you see, is coming from the proactive efforts that we have had in our existing customers and new. And these are longer range deals that we are winning. So I wouldn't say necessarily that we are seeing too many green shoots. There are some green shoots. We'll let the time pan out and see how this goes from a discretionary perspective.
Okay, thanks. And Sunil sir, looking at the margin walk which you have provided, with subcontracting cost and furloughs together impacting margin by close to around 120 bits, is it fair to assume furloughs may reverse in the fourth quarter and we can exit the fourth quarter with a 15% EBIT margin?
Yeah, so as I mentioned, the increase in subcontractors is on account of the ramp up in the recent deal wins. And this will continue for some time before the offshoring starts. So you're right in directionally we are working towards multiple levers to improve the EBIT margin, and that's the effort to continuously improve the EBIT margin from here on.
Okay, we'll come in the follow-up. Thanks.
Thank you, Sandeep. The next question is from Manik Taneja.
Hi, good morning to the leadership team. I hope I'm audible.
Yes.
So, a couple of clarification questions. Sunil, the first question is for you. When I look at our segmental performance, what we see is that through the course of last 3 or 4 quarters, our segmental margins on the high-tech side have been coming off, with the exception of this particular quarter. So what is explaining the movements in terms of segmental margins, given the fact that in the past we renegotiated the deal at the large customer, which was to step up the margins for the business? And also the second question is basically clarification on this large deal ramp up. Is this largely to do with the healthcare business, which was a deal that you won on the healthcare payer side in the prior quarter?
Yes, Manik. So the answer to the second question is yes, that is what is, but it is also not just that one deal. There are some other deals, as you would recall, we had announced in the earlier quarter, which are also ramping up. Coming to segment margins, what you mentioned about the high-tech margins, basically it is a function of 3 areas. The high-tech is an area where we have the larger ISV business, which includes the top customer. There are IP related revenues that are coming over there, not just in the large customer, but also in our Accelerate portfolio. And there is also the recent trend where we are seeing carve out kind of deals, right? There is also certain portion of IP revenues over there. So the margin is a function of if there are partner IP revenues coming in that, the margin conversion on that is lower. And in this quarter particularly, we had good accretive our own IP revenues, because of which the margin on the high-tech side is higher this quarter. So it's a portfolio of customers we carry, and the deals in every quarter may have, relevance to the way margins pan out. But overall, if you see, the gross margin is steady and we have been able to improve the EBIT margin as well.
Sure. Thank you and all the best for the future.
Thank you, Manik. The next question is from Ravi Menon.
Congratulations on a really good quarter, gentlemen. One question is on the healthcare side. If I look at your breakup of customers, it looks like there is now pharmaceutical companies, payers, providers, and clinical research organizations. Is this a change from the whole specific instruments and medical devices focus that you had maybe 3 years back? Are most of these new customers?
So Ravi, good observation. So if you look at our healthcare portfolio, we have had a good footprint in the scientific instruments, medical devices. That was the leading segment for us, which used to contribute a lion's share. We did have pharma customers, providers at scale. Providers is where our Salesforce business dominates in the US compared to our competition. What has happened is there have been some good accounts supersized in all these domains, and we have invested heavily in the payer domain. And some of the larger wins we are getting are additionally in the payer domain. So now it's a very well balanced portfolio across scientific instruments, medical devices, pharma, where we play mostly on data analytics, and the specialty pharma on the Salesforce front. Providers, where we are leaders based on Salesforce and other CX initiatives, and payers, where our next generation development capabilities as well as data analytics is playing out very well. So now, yes, it's more diversified and scaling in all of this.
And also see that you beyond the top 10 customers, the traction continues. So you explained also that you're seeing some wins from your private equity channel. Anything else that you could call out? Some of these customers, is there potential to take them to the top 10?
Yeah. So good question. So if you look at the mix of the wins that we have had, so as we have grown from being a $500 million organization to a $1 billion organization, as we have grown our capabilities significantly along with the addition of leadership teams and so on, we are now being invited to the much bigger bids. So today, if you look at the wins that we are having, they are against the top 5 in India, the big 5 across the globe, and so on and so forth. So the revenue mix, the client mix is changing. And to your point, some of these customers have the propensity to absolutely become among our top 5, top 10 customers. And you will see the top 10 customer mix changing in terms of the names moving in there, the quality of customers moving in there over a period of time.
Thank you so much. One last question on the SG&A side. You used to have about 20% of your revenue as SG&A, and now it's down to 16% or so. Do you think there is further leverage possible?
Yeah. So good point. Let me answer a few more things along with this. There have been a few questions alluding to the margin side of it before, and all of this comes together. So if you look at the sales and marketing side of it, if we look at our investments in sales and marketing, we have brought in a significant rigor to sales and marketing. We have over-invested in sales and marketing as well in absolute terms. If you look at it, if you look at year-on-year comparison, not just quarter-on-quarter comparison, we may be at a higher level in terms of SG&A from a year back. And part of it, whether it is direct SG&A investments, part of it are investments which are in enabling things which enable our sales to be much more productive, whether it is in our capability build around the private equity side, capability build around our AI and Gen AI side, capability build more deeper into certain parts of our cloud infrastructure and security, and so on. So all of them are enabling the growth, and there is definitely further leverage on the SG&A side as we go along. Now, let me also take this opportunity to answer the broader margin question before everyone asks us the margin question in different forms and shapes. We have said very clearly we will increase our margin from 200 to 300 basis points between now and the next 2 to 3 years. And I do want to recognize a mistake. On one of the earlier calls, I had said 150 to 200. Our intent is 200 to 300 basis points. I want to clarify. Now, let me build it up for you before everyone asks the same question. If you look at our utilization, today our utilization is at 81.5%. If you decipher that utilization into 2 distinct buckets, the laterals that we have and the people we hired from the campuses who are yet to become productive. And I'm talking of the volume hiring that we had done 2 years back. That hiring is yet to be productive more than 64% of what it was. Our laterals are running at 85%. So as a company, we have the propensity, if we look forward, to inch our utilization up from 81.5% slowly up to 83, 84, 85%. For each percentage of utilization going up, there's 30 basis points of margin that we release at the back end. So keep that in mind. That's one part. We talked about the SG&A leverage. So we have invested significantly in our SG&A, and not only SG&A in terms of sales force, but if you look at the leadership hires that we have brought on board in the last 1 to 2 quarters, those are leaders that will kick in high gear as we move along. They don't have the impact on the current quarters. They're just settling in. But as we move into the next financial year, we will have a leverage of that. Then again, if you look at things like our facilities and so on and so forth, there is certain amount of leverage that will come in because we invested in certain facilities. You would have seen many announcements in India and outside. And as we see our revenue growing, all of those is going to kick in. It is not going to necessarily increase in line with the revenue part. Not to mention the amortization that we have from the earlier M&A that we have done. As our revenue increases, that also gets defrayed over a larger thing. So overall, from a margin perspective, we are reasonably sure, and we have initiatives inside the company where we will incrementally, whether it is next quarter or the next few years, move up. Now, obviously, in certain years when the macro is soft, we will not press the trigger on margin improvement that hard. If you look at the current year, we wanted to make sure we come in first on the top end of the growth quartile, and then comes the margin initiative. And as the economy stabilizes, the focus will move, and it will always be a cross balance with growth being the first priority. So with that, back to you, moderator.
Thank you so much, President.
Thank you, Ravi. The next question is from Karan.
Karan, we can't hear you.
Hi, can you hear me now?
Yes.
Okay, great. Again, obviously congratulations on a fantastic quarter, and looking forward to see what comes ahead. So I just wanted to dig a little bit into the Gen AI pipeline. And let me start with a basic question, which I know you won't answer, but I'll try anyways, and then I'll ask just a 1 or 2 sort of follow-up question to that, which is, is it possible, to get to sort of 100 million of revenue from Gen AI, over the next 2 to 3 years, just in terms of size, scale, and scope? Of course, there's no kind of firm guidance or anything, but just in terms of how big it can be. And I guess as part of that, my question would be, can you add some color on just the size of the pipeline, in the sense that, how many of your 176 clients have some kind of POC, related to Gen AI? And then related to that, what percentage of POCs are leading to production? We've seen surveys where actually the vast majority, more than 50% of POCs will enter production. So actually the technology works broadly. And I think everybody understands and realizes there's a lot of POCs out there, but they have an uncertainty around what that conversion rate will be. But the leading indicator seems very strong. So if you can just add some color there. I know a lot of questions there, but whatever you can add.
Sure.
On those best points.
So the first question, can Gen AI lead to a $100 million business over the next 2 to 3 years? Look, anything is possible. And so Gen AI is one form of AI. And look, Gen AI cannot be implemented beyond POCs till the time you have an enterprise-wide, wherever use cases you are trying to put clean data available to you in very simple terms. And if you have to do that, Gen AI, you should look at it as a tip of the spear. For us to be able to deliver to any enterprise, and for any enterprise to be successful on Gen AI, it will spawn off many different initiatives, which will involve data engineering, data cleansing, many other things. So Gen AI in absolute terms, just as a simple use case, will have many other things. If you put all those things together, can it lead to $100 million business for us over the next 3 years? Absolutely, the answer is yes. Now, we'll let the time pan out, and we are not going to get into that conundrum of now report your Gen AI, revenues like people used to do digital revenues and so on. I think Gen AI is going to be mainstream in everything that we do in next 2 to 3 years. So keep that in mind as well. Now, second part, of the 176 customers, how many POCs are we running? Today, if I was to look at overall at Persistent, there are more than 75 plus POCs that are running on Gen AI in different forms and shapes. How much of those will get to production? We'll see how that flows in. Today, any boardroom, whether it is ours or our customers, there are discussions on Gen AI. And that spawns off initiatives, and CIO organizations, CTO organizations, the business leaders are given the mandate to go and experiment with Gen AI in their own fields. And that's what is leading to those POCs. And that's what is also leading to the collaborative agreements that we have with the Amazons of this world, the Googles of this world, Microsofts of this world to go and do more POCs so that we can unlock the aperture and people look at different possibilities. Very hard to say how much of those 50%, 100%, what will lead to production, but over a period of time, it will definitely lead to good amount of revenue uptake. One last thing I'll say on this. Not everything will lead to GenAI. GenAI is one form of AI which is easy to use and so on, but also keep in mind, the bills on GenAI can very soon go up for enterprises. And there are alternate forms of AI which are available. Not everything needs to use GenAI as a use case. And we have been doing that for many years. That's why in my prepared comments also I refer to. So we are very positive about AI being there in every part of persistent service lines, digital engineering to Salesforce implementations to the cloud infrastructure security and so on. And you will see us announce many more initiatives in the next 3 to 6 months. Back to you, Mohan.
Thank you. Thank you so much.
So Sandeep, there is a question on the chat, a related one on GenAI, where Gaurav Rateria is asking us, have we been part of discussion in helping clients save costs somewhere else by becoming more productive and channelizing those savings in these GenAI initiatives?
Yeah, so look, every enterprise or every enterprise software company, at the end of the day, their ability to spend, if I may say so, their expense budget or their pot of gold is only limited. So when a number of people are looking to forward-looking initiatives, and this is nothing new, this has been happening for long. People look at where you can reduce the spend in business as usual and take that to more next generation initiatives. In this case, it is GenAI. And there are other ways also people are looking at us to help them, whether it is enterprise software companies or enterprises, right from developer productivity, looking at their own implementations of developer productivity tools like Microsoft GitHub Copilot or AWS Code Whisperer, to many other things that we bring to bear with our IP, like report rationalization tools and so on. There are many things that are there on cost reduction and taking that money to see how we can impact the revenue side of it or customer experience side of it using GenAI. So yes, there are many initiatives like this.
Sure. We'll take the next question from Abhishek.
Hi, thanks for the opportunity and wish everyone a happy new year and congrats on a good quarter. Again, a related question to the topic we are discussing. So Sandeep, there was a comment about an increase in the cost of ownership of software products in one of the industry analyst call last week related to GenAI spend. So first, question is on that topic is, are you seeing an increase in product engineering spends because you have a very strong relationship with software product companies? And second, is there a trend in terms of because of that spending, will see a moderation in non-AI related spending, including cloud migration related spends?
Yeah, so we are talking two different things here. See, the second part that you talked about, the cloud migration and so on. So that is much more relevant in the enterprise world because a number of enterprise software companies are today more and more cloud native in their new product development. And a number of them who are there from the past have already moved their legacy products to the cloud in one way or the other or are going to sunset that. Now, as far as the spend on GenAI is concerned in enterprise software, is there more adoption of that? And broadly AI? Yes, it is. And everyone, is trying to control their budgets, moving money from where they can squeeze on the business as usual support side of it to doing feature enhancements using GenAI, doing co-pilots, doing other, things from a CX perspective, customer support perspective in enterprise software and so on. So yes, there's a movement and we are gainers of that. And, it's early in the game. It's not just that, today GenAI is accounting for majority of our growth, but GenAI and AI over the next few years will definitely account for more and more revenues for us.
Thanks for taking my question.
Thank you, Abhishek. The next question is from Dipesh.
Dipesh, we can't hear you yet.
Yeah, can you hear me now?
Yes, please.
Can you hear me now? Okay.
Yes.
Two questions. First about the private equity channel. I think now last couple of quarters we have seen couple of success in private equity channel. So can you just help us understand what we are doing differently, which works well for us, and any specific action we have taken which drives success. Second question is about revenue composition change. We don't report service mix, so just want to get sense, let's say 3 years back, kind of what we used to do, how it has evolved in 3 years, and if you can help us understand how you expect it to evolve in future. Thank you.
Yeah. So I'll take the first question, second I'll let Sunil answer. So from a private equity channel, if you look at it, we have been developing this channel for the last 4.5 years. And we have hired people who understand this channel. And so our private equity channel is housed with folks who have worked for private equity or worked in companies that have serviced private equity. On one side, we are mapping to strategic private equity folks like accounts. So look at them as accounts we manage at the highest level. On the other side, the capability, at the end of the day, it's all about the capabilities that you bring to bear. So we understand what a private equity firm needs and what their portfolio companies need. So we are partnering with private equity right from the stage when they're evaluating deals. So we have certain tools, techniques, methodologies that we have perfected on that. We help them analyze companies, the platform. So right, using from our digital engineering capabilities to analyze the platforms that these companies that they're trying to acquire, the maturity of those, their hypothesis on engineering effectiveness, the capability to cost reduce using different levers and innovate using the forward-looking technology. So we are right there when they are evaluating deals. To the time the deals are brought in and there is work to be done. If it is a carve-out, we have more and more become a carve-out specialist where we have tools, techniques, methodologies to de-risk the transition services and so on. So across the private equity spectrum, right from pre-diligence to diligence to the value realization once a company is acquired to even the exit, we have a very clear set of service offerings, and those are well proven along with the IP assets that we have built to deliver these. So that's what is differentiating us and increasingly making us the preferred partner for all these large private equities as they go to field. And you have seen a number of our wins come from that. Now, Sunil.
Yeah, Dipesh, so in terms of the services and IP-led revenue composition, if you want to understand the growth profile, yes, both the parts of the business have been growing. And if you take a period of 3 years, the only thing that has moved is the large deal that we had, which we discontinued at the end of 2021. So that's the only period when the IP-led revenue had a bump up because of that, contract. But otherwise, on our own, whatever accelerators, our own IPs in the Accelerate portfolio, and the new work that we have been doing in multiple areas, where we are able to bundle our own solutions to customers.
Sunil, I was not looking for that service IP. I just broadly understand, let's say in services, composition of revenue, how it is changed. Let's say earlier we used to have very large sales force skewed kind of revenue. So over a period of time, how broad-based that revenue mix is changing?
Fine. Let me take that question, Dipesh. So if you look at our services mix, and I alluded to that earlier in the call as well, as we have grown from being a firm which was $500 million to a firm that is beyond $1 billion now, and we have also built capabilities, whether it was building more capabilities right from our cloud native and the digital engineering side where we have always been very differentiated. We have built on capabilities on those. We have added on application maintenance and support capabilities, the ASM part of it. We have built on the cloud part of it in terms of doing the next generation infrastructure on the cloud ops and so on. We've built significant capabilities on data side. So what all this brings together is when anyone is looking for at a, one of the, let's say, Fortune 1000 companies looking at, doing a RFP and wanting to bring one or two challengers in the mix as they look at their current, providers, we are definitely being involved. And that is where, if you look at some of the larger wins, we have won against the top 5 in India, the top 5 globally, and so on and so forth. So the services mix is changing towards, a lot of people think Persistent is discretionary. I would tend to believe Persistent is a lot more non-discretionary today than what it was, 3 to 4 years back. So from that perspective, long-term deals across these segments, stickier revenue, NVT revenue, that is the kind of services mix that we have built over the last few years. And that's where we are going, while not losing the sense, the ethos of making these differentiated. Even our AMS, the application maintenance and support, we bring a lot of tools to bear. A lot of AI is what we are infusing in that. So it is the next generation ops, the next generation development, and so on. That is what is there. But the mix is definitely changing.
Thanks.
Thank you, Dipesh. The next question is from Chirag.
Hello. Congratulations on a good set of execution in challenging times. So, Sandeep, what's our M&A outlook for next 2 years?
So if we look at our M&A strategy, it has been built on small tuck-in acquisitions, which are based on the capabilities that we want to enhance or a geographical footprint that we want to enhance. So we keep evaluating deals. Obviously, we have to make sure that the deals have the right fit, both from a technology, cultural, and the valuation standpoint. From our next 1 to 2 years, we'll be focused on deals on the cusp of AI, cybersecurity, in terms of going into verticals, micro verticals within banking, financial services, healthcare, life sciences, and finally, from a geography perspective, tuck-in acquisition in Western Europe from a revenue/customer acquisition perspective, because Europe is one place where we do want to scale up in terms of our revenues, and a delivery in Eastern Europe. So those are the broad contours, and we are on the lookout for good targets. And if anyone on the call has anything to refer to us, please let us know. And Saurabh also leads our corporate.
And just one follow-up, vertical-wise, in AI-based offering, which vertical you feel will get more revenue acceleration once client, look for more deals in AI-related areas?
So our point of view is this is going to be a secular adoption of AI. Having said that, healthcare life sciences has usually been a laggard in terms of adopting newer technologies. We do believe healthcare life sciences followed by BFSI will be the way we will see the population, but we'll let the time pan out. And then there are several use cases like contact center optimization using Gen AI and so on, which are agnostic of all the verticals. So there are certain horizontal prepositions and there are certain vertical prepositions.
Okay, thank you.
Thank you, Chirag. The next question is from Mohit Jain.
Sir, just one question. On high-tech vertical, this quarter was little slow. So if you could share your outlook on that vertical, and if you could split it between, say, top client and the rest of the high-tech, how should we look at it going forward? Thank you.
So Mohit, as you would have seen, our top client declined a little bit in this quarter, and it was a planned decline based on a particular large program. It has a profile where we had a certain amount of revenue going up, and then it has a certain tapering. So that is what caused a little bit of protuberance on the high-tech vertical. And if you look at the high-tech vertical, that has been a very strong vertical for us for growth. And so, small blips will come here and there because of, one or two things. And December being the quarter where there are furloughs, there were some minor things there as well. But nothing to worry there. If you look at our overall growth, we've said that in the past, it'll be led by healthcare life sciences and high-tech followed by BFSI. So that's where it is.
So operator, can we take the last question? We are coming to the end of the slot.
The last and final question is from Vibhor Singhal.
Yeah, hi. Am I audible?
Yes, please.
Yeah, hi. Thanks for taking my questions. Sandeep, just one question from my side. You just mentioned AI, cybersecurity as probably the focus areas for our M&A. But as you mentioned that if you look at a profile at more than $1 billion today, do you believe those traditional areas of, let's say, ERP or let's say BPO, which are kind of white spaces for us, would you also be looking to expand your portfolio in them as we become full service companies? And as you mentioned, we get attracted to more, invited to more and more large deals. Wouldn't our, let's say, I wouldn't say inferior, but let's say a lesser capability in those domains hamper our chances to win those deals? Any thoughts on that in terms of growth, whether organic or inorganic that you're looking at?
Sure. So we were valid questions, but look at it this way. We are $1 billion company in a much, much bigger market. As far as the ERP side is concerned, number one, there are much more mature players in the market. And second, I would tend to believe, ERP basically plays the role of a system of record. There's much more that can be done on top of it in terms of systems of engagement, and that's where we play. So there is, if I am given $100 in investment, I wouldn't want to go after a red ocean. I would want to build on our capabilities, and there is enough and more market there. Same for BPO. Where we play in the BPO realm is we go and disrupt the BPOs. We go and disrupt the BPO using technology, using Gen AI, and so on, making BPOs much more effective, reducing the OPEX on the BPOs using technology. And that's where, we have enough and more to do. Now, in terms of larger deals, when you go to large enterprise customers, they don't usually go with one single, provider. So they go with a mix of providers, even if they're going with large or, a bunch of disruptors. And so there is a way to partition the deals in a way where everyone brings their strength. And the biggest strength that we have is on forward-looking technologies. And that is where there's a significant amount of addressable market for years and years to come. So we'll stick to our knitting. We'll bring AI into it. We'll bring differentiated capabilities much ahead of our larger peers and mid-cap peers. So that's where our focus is at.
Got it. Thank you so much for taking my questions and wish you all the best.
So let me try and close this call. The key message that I want to leave with our investors today is that we have delivered top quartile revenue growth for the last 15 plus quarters. Now we are looking at good deal bookings converting into revenues going ahead despite a difficult macro environment. We'll continue to operate as a strategic partner to our customers and enable them to drive their key business imperatives. We are positive on our growth prospects going forward, although we are cautiously optimistic on the macro environment. Nonetheless, we'll watch this macro developments and we'll ensure that we'll remain relevant to our customers. We once again thank you for your participation, and we thank our 23,300 plus team members, customers and partners for their support in our growth journey. We look forward to giving you an update in 3 months from now. Thank you.
Thank you.